Welcome to XM.com. You're watching the special report video. We'll be looking at the stagflation risks in the market. I'm Christina Marujos, and joining me today is senior investment analyst Marios Hadjikyriacos. So, Marios, the mood has improved this week, but global markets are still grappling with a variety of risks, from broken supply chains to soaring energy prices to a slowdown in the Chinese economy. Can you outline these risks for us?
Hello, Christina. With pleasure. So let's start with the supply chains. They've been a theme for a very long time, and it started with the lockdown. So when you lock down the global economy, a lot of containers are not loaded onto ships. That slows down international trade, and the prices for shipping and transporting containers go through the roof as companies start to compete each other to get their products shipped on time. Now, it started with the ports, but this has actually spilled over into the mainland lately, thanks to a shortage of truck drivers. So even if you can unload the cargo from the ships on time, those goods are often stuck at the ports because there isn't enough manpower to transport them to warehouses. And even more fun is the fact that a lot of these warehouses are already full because, again, there aren't enough truck drivers to transport goods from the warehouses themselves. So it's a huge logistical mess at every step of the supply chain. Now, the energy crisis is probably even worse. We've seen natural gas and coal prices go through the stratosphere lately in Europe and China, and that's really threatening to hold back economic growth, but also keep inflation hot. Now, how did we end up in this mess is the real question. And there's a long list of reasons. There's chronic underinvestment in fossil fuels, there are tighter emissions regulations, transportation bottlenecks, low inventories, and even the wind not blowing enough this year to power wind farms. Now, the good news is that Russia recently offered to provide some more natural gas to Europe, and that might help the situation out. But still, I think this is a massive risk. It threatens growth. It also threatens the consumer as electricity bills go higher. And the only major economy that I think could escape with very little injuries is America, because the US is self-sufficient on energy. It's energy independent. So the damage will probably be smaller relative to Europe and Asia. And the final one is China's hangover. So everyone has heard of Evergrande at this point, the over-indebted Chinese property developer that is headed for bankruptcy. Now, initially the markets panicked that this would cause a domino effect of serial defaults and that would spread into the banking system. But at some point the government made it clear we are not going to allow that to happen. We are going to ring fence this whole thing. Now, the real risk for me was never that. Instead, the real risk is what happens to the real estate market. The real estate sector in China is huge. It's around 30% of GDP. And for decades, this sector relied on debt-fueled growth. Now, that recipe is dead because the government is tightening leverage rules. So long story short, I think we're going to have a massive hangover in the Chinese property market as companies clean up their balance sheets. And that could ultimately hit growth in China.
And now, having said all this, what is the potential impact in the markets from stocks to currencies?
Well, let's start with stocks. So I think we're headed for a period of slower growth but elevated inflation as the supply disruptions and the energy prices filter into the markets. Now, that implies a situation where companies get hit a little bit. Companies can't cover demand because their goods are not arriving on time, and that chokes growth, and their costs are rising at the same time. That ultimately squeezes profit margins for companies. And it's also horrible for the consumer, right? Because you have higher electricity bills, and at the same time, you are faced with higher costs at the grocery shop and everything else. And that essentially takes a bite out of real incomes. I think this is a pretty negative environment for stock markets. We have seen a correction, but the markets have already forgotten about it. The mood has improved dramatically this week. I think there's still scope for some retracement though, because I think this is a story that's going to be around for several more months. Now, in the forex market, the winner, I believe, will be the US dollar. You have the US economy, it's independent on energy, so the energy crisis is not going to affect it that much. You have Congress preparing another spending package to juice up growth, and ultimately this allows the Fed to raise interest rates to fight inflation, which is a luxury that neither the European Central Bank nor the Bank of Japan can afford. On the opposite end of the spectrum, I think the losers from this are going to be the euro, the yen, and the Australian dollar. Now, the euro is pretty obvious, it's in the middle of the energy storm. The Australian dollar is really exposed to China, so Australia's economic model essentially has been exporting raw materials to China for decades. So if we see Chinese growth slowing down because of the property sector, then demand for Australian exports could take a hit as well. And for the yen, it comes down to interest rate differentials. If the whole world is afraid of inflation and inflation stays hot, that means yields go higher, and higher yields usually destroy the Japanese yen, which is exactly what we're seeing play out in the markets right now. Now, having said all of this, I don't think this is a catastrophe either, right? Growth might slow down, but it's unlikely to lead to another recession. Supply chains will ultimately correct, but I think it's going to take a while longer. So I think we're facing a period of a few months or even a year where supply and energy problems keep the markets guessing. The good news is that once we see signs that the supply chain is improving or that energy production is coming back online to cool energy prices, then I think we're going to get a very powerful rally in every asset that got beaten up previously.
Marios, thank you for joining me today, and thank you for watching this special report here at xm.com.